If you think the 2008 global financial crisis was bad, then you have no idea what could be around the corner. With record levels of debt and a stock market and a real estate market that's pushing further and further into record territory on the back of record low interest rates and cheap debt, along with inflation starting to become an issue. With so much money printing by all the central banks around the world at the same time, it was only a matter of time before inflation starts to show itself. In my personal opinion, in the near future, the governments and the central banks around the world will have to choose between letting inflation get out of control or increasing interest rates, either of which will have a dramatic impact on the stock market and the real estate market. I don't think people truly understand the gravity of this situation. So I think it is very important for us to educate ourselves and understand how bad things can get. In today's video, we are going to go into detail about exactly what the future could mean for us and the consequences of all of this money printing and cheap debt, and how I plan on 1. Protecting myself, and 2. Making profit from the high levels of inflation that we are about to witness. Today's video is going to be packed full of useful information, so I would strongly recommend you to watch it till the very end so you don't miss anything. As always, please understand that this is not financial advice and I am not a financial advisor. I'm simply sharing my personal opinion with you lovely people. I will always recommend you guys to do your own research and due diligence and seek the help of real financial experts when it comes to making big financial and investment decisions. And without further ado, let's get straight into the video. Let's start by talking about this situation that we find ourselves in. Let's forget about the pandemic for now and focus purely on the government policies, the record low interest rates, the real estate and the stock market. So how do we get here? How do we go from a global shutdown and one of the worst economic shocks in our modern history to record high asset prices, a stock market that is booming, and a real estate market that is growing at 2% a month? Well, there are hundreds, if not thousands, of different factors that have all worked together to bring us to where we are today. But if I wanted to just give you the most simple and most easy to understand answer, it would be 2 words: cheap debt. As discussed in my previous videos, there's a strong correlation not only between house prices and interest rates, but also the stock market and interest rates. One of the main drivers for real estate price growth used to be income and wage growth. As people got paid more money, they were happy to spend more money on a property. Nice and simple. However, as we can see here in this graph provided by The Guardian, showing the wages and residential prices index, this has not been the case for a very long time. And the growth that we are seeing in our markets is driven by something else. So what's driving all of this growth? The answer is record low interest rates and cheap debt. If we now look at this graph showing the interest rates over the same period, we can see almost a direct inverse correlation. As interest rates drop, house prices increase. And this will make perfect sense because as interest rates drop, people can now borrow more money at the cheaper rates. And as this data and history has shown us, people will borrow more money if they're given the chance to. This is because the strongest emotions that influence our decision making when it comes to investing are greed and fear. And this is the perfect example of greed. So when people are seeing the stock market and the real estate market head into record territory, and the people around them are telling them about how much money they have made from owning an investment property or buying shares, they get a sense of fear of missing out, and they want to also make some money. And this is where greed comes in. This is defined as a herd mentality. And I believe this is exactly what we are seeing in the real estate market right now, with people offering and paying insane prices to get into a property because they are seeing so much growth in the real estate market and they don't want to miss out and be left behind. Because after all, house prices can only go up, right? Let's talk a bit more about how strongly interest rates can influence property prices. Based on data and historical trends, while we can see there is a strong correlation between interest rates and house prices, this graph provided by Your Investment Property magazine indicates that house prices can still go up with increasing interest rates. And this happened multiple times between 1988 and 2008, where the interest rate and house prices moved in the same direction. Surely this means that when interest rates rise in the long term, this is going to have a very small effect on the property market. right? Personally, I believe that when the interest rates do rise in Australia, we are going to see a correction in our housing market. And here is why. This graph provided here shows the wage growth in Australia in the last 30 years. And as you can see, wages have been growing strongly right up until more recently when it started to plateau. When there is strong wage and income growth, people are not too worried about a 1 or 2% increase in interest rates because they can still make repayments because their income is increasing. However, we all know that this is not the case anymore, and we are unlikely to see any real growth in income or wages in the coming years. This means the sharp increase that we have seen in our property market are largely due to the cheap debt that we are using to push up property prices. To further illustrate my point, let's look at another driving force for property prices: immigration and population growth. According to statistics provided by the Australian Bureau of Statistics, since 1980, migration made up between 17.8% to 65.7% of total population growth in Australia, meaning migration was crucial in getting Australia to its current population of 25 million people. Due to the strong influence migration had on population growth, it would suggest that it also had a strong influence on growing property prices. Fast forward to now, with our borders all but closed, there is no migration to drive up property prices. And if there's no wage growth and there's no migration, then what's driving up house prices? Once again, the logical answer here is interest rates and debt. And this is where it gets scary, because what happens when it's cheap debt is no longer cheap? If we are going to talk about asset bubbles, then we have to talk about the greatest economic shock that we have seen in the last 100 years. And that, of course, is the Great Depression. If we go all the way back to the 1920s, we will see that the US economy back then was in a very similar position to it is now. During the Roaring 20s, investors made a staggering 150% return in the stock market between 1922 and 1927, with tech stocks leading the pack. And it was almost uncommon to not own any stocks. In 1927, the Fed lowered interest rates from 4% to 3.5%, and this was when the herd mentality kicked in and the markets really took off, with cheap debt fueling both the stock market and housing market. With so much growth and everyone around you all borrowing money to buy stocks or real estate, why would you not do the same? Especially since everything only went in one direction, and that was up. From 1927 to 1929, stock prices more than doubled, with many stocks trading at more than 30 times their earnings, which is also known as the PE ratio. Does all of this sound familiar to you? With the central banks lowering interest rates, which leads to excessive borrowing in a herd mentality manner, with many inexperienced investors borrowing way more than they should. It is almost scary how much our current economic conditions resemble that of the 1920s, just before the Great Depression. And the most scary part is that the current property boom is being driven by first home buyers. And unfortunately, many first home buyers just haven't had the experience in the market and are the most likely to overstretch themselves financially. This will also mean they will be the first ones to face repayment difficulties when rates do increase. This is why I remind my viewers to be aware of the fact that interest rates will go up in the long term, and that we need to be confident that we can make repayments when the rates do go back up to their long-term average of 6%. Another prime example of how crazy the property market is right now is the situation that I encountered when I was helping a friend with her investment property. As most people who are looking to purchase a property right now will understand, it is almost impossible to find a good deal. You're expected to pay above the quota range to have any chance of securing the property. And even when you do, you're still likely to face competition from many other desperate buyers who are willing to pay just about anything to get into a property. A property market that I was looking at where properties were selling for $200K just 4 months ago has now become a $260,000 market. And we were trying to find a property in this market. And after some negotiations, we were able to secure a property for just under $300,000. And upon receiving the building inspection report, we quickly pulled out of the deal because of the termite activity, the minor defects, as well as the major defects. After we pulled out of the deal, the property was quickly snatched up by another buyer, and quoting the agent, The new owners were not concerned by the issues. I could not believe my ears when the real estate agent told me that the property was sold for just a few $1,000s under our offer, meaning that someone had just paid $300,000 in a market that was only at $200,000 a few months ago. And the property also had termite damage, minor defects, and major defects, which did not seem to concern the new buyers at all. The only logical answer that I could give in this situation is that it was purchased by a very inexperienced investor or first home buyers who did not do their due diligence. If this is the kind of stuff that is happening in our property market, it makes me very concerned about what the future might bring. This brings us to our next topic. Knowing how fragile the economy and the real estate market is and how dependent it is on the current low interest rates, why on earth would the government ever increase interest rates? The answer is inflation. The governments and the central banks around the world all have a target inflation rate of between 1% to 3%. This keeps the economy growing in a steady and healthy manner. But what happens when there is too much inflation? In 1928, the Fed increased the interest rates from 3.5% to 5%, and then again to 6%. So why did they do this? Even though I can't say for sure, but if I had to guess, it wasn't because of the growing wealth gap between the haves and the have-nots, but rather due to the debt-fueled inflation that was starting to creep up. Even though inflation can be healthy, too much inflation can lead to hyperinflation, which is the last thing the governments want, and can lead to rapid, excessive, and out of control general price increases in an economy. This is known as hyperinflation. We have all seen what hyperinflation can do to a country such as Germany after World War I. Like this photo here showing someone pushing a wheelbarrow of money to purchase simple everyday goods like bread. Hyperinflation is usually caused by a massive increase in the money supply, which devalues your currency, meaning you will need more and more of it to purchase the same goods and services. A massive increase in the money supply. Does this sound familiar? With all jokes aside, the fact is that central banks around the world have all been printing money like crazy, and it was only a matter of time before inflation creeps up due to the massive increase in the money supply. Even though we haven't seen hyperinflation yet, and with all the central banks around the world denying inflation as an issue, the recent sell-offs in the bond market as investors became concerned about the bond returns not keeping up with inflation, as well as the massive rallies in the stock market and the real estate market, are all signs of inflation. We can't simply increase our money supply by $100 billion, or in the case of the US, a few $1 trillion, and not expect to see inflation. With the speed of recovery, particularly in Australia, I believe it is only a matter of time before inflation shows in a form that demands action from our central banks, at which point they will have to combat inflation in the only way they know how, by increasing interest rates or reducing the money supply. As we have learned from the Great Depression and the global financial crisis, when an economy that is in so much debt is forced to increase their interest rates, we are likely to see a correction in the many asset classes of that economy, such as the stock market and the real estate market. As most of my viewers already know, I am quite bullish on property, and I do have a pretty large real estate portfolio. But knowing what I know now and how bad things can get, does this mean I'm going to sell all my properties and completely liquidate my positions? The answer is no. I think one of the worst things that you can do is try to time a market and predict when a crash is going to happen. Again, this is not financial advice, it is only my personal opinion. When you try to time the market, the first thing that you're going to do is that you're going to miss out on a lot of growth. Yes, a crash is scary, but what comes before a crash is a boom. Yes, I know the stock market and the real estate market are very different, but a very similar principle applies when it comes to trying to time the market. If you're not sure where I'm coming from, just ask those who have been sitting on the sidelines and predicting a property crash for the last 20 years. This is why I don't plan on sitting on the sidelines and waiting for a crash to happen while I lose money to inflation, because this could take 2 years, 5 years, 10 years, or even more. Another reason why I don't plan on selling any of my properties anytime soon is because I plan on selling my properties when I retire in 30, 40, or 50 years time. And by then, my properties are going to be worth a lot more than what they're worth now. In my previous videos, I've spoken a lot about the importance of rental return and low vacancies. And I think this is the perfect time to demonstrate why these are so important. My current investment portfolio provides me with a rental return of around 6%, and most of my properties have a very low vacancy rate. If the interest rates were to suddenly go up by 2 or 3%, this is not going to put me under a lot of pressure, because my tenants will still be paying for most of my repayments. This combined with my emergency fund should see me through any recession or any depression that is likely to happen in the coming years. I know what some of you guys are asking. What if people start losing their jobs and they can't afford to pay rent? This is why we are so lucky to live in Australia, because we have welfare. If the worst were to happen, the government will support us. I did my due diligence and planned for the future, so I know I'll be okay when the worst happens. However, my concerns for those who have not done their due diligence and have stretched themselves financially in expensive markets with low rental returns and high vacancies. Yes, I'm talking about the expensive markets of Melbourne and Sydney, and I know a lot of you guys are going to disagree with me on this, and that's completely fine. We are all entitled to our own opinions. As we saw at the start of 2020, where things were starting to get bad, it wasn't the small regional markets that took the biggest hits. It was instead Melbourne and Sydney which saw the most corrections. To understand exactly why this is, we need to evaluate the situation from a numerical perspective. These bigger markets have higher levels of debt because the properties are more expensive, and at the same time, these properties have lower rental returns. This combined with higher vacancies is going to lead to repayment difficulties. It is actually quite simple and straightforward. It is basic math. And this is why I have decided to not invest in these markets under the current conditions outside of doing developments where I can quickly build up some capital. At the start of the video, I promised you guys that I will be sharing with you my investment strategy to 1. Protect myself and profit from inflation. So here it is. First of all, I will protect myself by not financially stretching myself in expensive markets with high rental vacancies and low rental returns. And second of all, I will be diversifying my investment into other asset classes that have proven to do well during economic shocks, such as gold. A lot of people are very skeptical about gold and other precious metals, so I won't try to convince you why it's good or bad. But my personal view is that if it's good enough for billionaire fund managers like Ray Dalio and the central banks around the world, then it's good enough for me. I see it almost as an insurance policy on the crazy monetary systems that we have today. An insurance policy that grows with inflation. And lastly, I will be leaving my real estate portfolio as it is, because I know I'm not going to be able to time the market correctly. And I'm also investing for the long term, so I'm not concerned about these short-term corrections. As this graph indicates, based on historical data, in times of strong inflation, real estate and gold are some of the strongest performers. And I believe these asset classes are going to do really well for me in the coming years, as we head into an era of high inflation. To conclude the video, I just want to make it clear to my viewers that investing is not a get-rich-quick scheme. It is rather a lifelong journey that builds wealth over time. Those who seek to get rich quickly are usually the ones who lose money the fastest. And we should never stretch ourselves financially, because doing so is going to lead to long-term consequences that will take a lifetime to fix. Just because the people around you are paying ridiculous prices to get into a property, it doesn't mean you have to. Don't become part of the herd. Make your own decisions based on your own circumstances. With that said, I am not a financial advisor and this is not financial advice. You should always seek the help of real professionals before you do anything crazy. I wish you the very best on your investment journey. And if you got value from this video, please support the channel by clicking that like button right there and subscribing to the channel for more content just like this. And if you have any questions or just want to have a chat with me, you can add me on Instagram at investwithzeng, where I post daily content just like this. And I'll see all of you guys in the next video.